Hello, everyone, and welcome to this session entitled Unlocking Society's Benefits Through Venture Capital and Startups in the Post-COVID Era. I'm Nina Raval, partner in co-edit Trill Impact Ventures, which is a Stockholm-based venture capital fund, and I have the pleasure of moderating this session today. So when thinking about venture capital and startups and the role they can and must play in the years to come, we must first start with the challenges we face. So between the transition to a green, sustainable economy, equality, and better health for all, we as a world have our work cut out for us. It's perhaps easy to understand that new technologies will play an important role in reaching these goals, but are the financial markets structured in a way that allows for the required risk-taking and long-term goal setting to take place? Can commercial returns be combined with improving the world? I'll state up front that I'm heavily biased. As an impact investor, I'm convinced that the pressing need for a healthy planet and healthy people, combined with continuous regulation and steadily increasing consumer demand, represents a huge business opportunity. And companies that offer products that enable green transition or better health for all, I think will also be market winners in the years to come. But of course, in a wider context, this is still a minority view. Many people still consider profit and purpose to be mutually exclusive. So what do we learn from the pandemic? What can we expect ahead? And importantly for this session, which role should venture capital play? These and many more topics are what we're going to be discussing during this session. And to do that, I have a great and highly knowledgeable panel with me today, which I will be introducing as we meet them. They represent policy and kind of the EU stimulus perspective and stimulus capital. We have the academic perspective from some of the world's leading institutions thinking about what VC could do and also monitor what we actually achieve. And last but not least, we have some active VC investors. So the way we're going to run this session is that we're going to have opening statements from all the panelists, which will kind of set the scene for the panel discussion that we move into afterwards. Really would like to engage with us over the chat. Actually, I hope that's possible to make it as an interactive session as possible. So with that, I'd like to welcome the first speaker, who is Javier Gonaga, head of the Knowledge for Finance, Innovation and Growth Unit at the Joint Research Center of the European Commission. So please, Javier, the floor is yours.
Thank you, Nina. Hello, everybody. I'll be switching off my camera because I seem to have a problem with my Wi-Fi so that you can hear me properly, okay? So I'm going to share with you two good news and a big challenge that I see in the EU. For your information, I represent the Joint Research Center. We are a service of the European Commission that analyzes evidence on various policy issues and try to identify challenges that should be addressed by policy. And I implemented from my colleague Rudy Aernoudt in a minute. Now, what are the good news as far as I can see? First of all, in 2021 vis-a-vis 2020, in a minute, the amount of venture capital that was invested 150% vis-a-vis 2020, the year before. That's a huge increase, much greater than the increase that we saw in the US. We have to say also that much of this increase was due to investments coming from the US, which shows to some extent that the projects, the business that were being proposed by European entrepreneurs were attractive to the leading venture capitalists in the US. The second good piece of good news is the fact that in recent years, the number of startups created in Europe is at par with the US. That's excellent news because it's the pipeline of future unicorns, future global companies. And here we have also a new institution in Europe, which is the European Innovation Council, which we think is going to help many of these startups that are deep techs, providing tangible innovations to be brought into the market with funding in the early stages of their development. So those are the two pieces of good news that we see. What are the big challenges, or the big challenge that we see from our first of all, very substantial, has been growing very substantially over the last few years. The overall difference in venture capital investments in the EU vis-a-vis US is huge. We have 4 times more venture capital in the US than we have in the EU, maintained over a number of years, 10, 20 years. And that has created a kind of a structural disadvantage in our view in the performance of our industrial sector, Europe, vis-a-vis the US, Italy, cities, services, and the health sector. That are the ones that attract also most of the venture capital. Having said that, we also see that in recent years, a lot of venture capital is beginning to go into the renewable energies sectors, which is growing very fast. And there we in Europe, we are well positioned, but still that overall amount of venture capital going to EU ventures is very low vis-a-vis the US. So what can we do about it? I'll just begin to prepare the ground for my colleague Rudy on this issue. We think that we have 2 main problems. One is the fact that the venture capital funds in Europe are very small, and they cannot fund the later stages of the development of startups that need between 20 and more than 100 million euros. And we also have that the amount of public venture capital is very high already. So we cannot expect the public sector to be the solution to fill in the gaps, to funding the scale up of companies. So we think that we need to mobilize the private sector, patient capital in pension funds and insurance companies. And I think that my colleague Rudy has part of the answer to that challenge. So with that introduction, over to you, Nina, over to you, Rudy.
Thanks a lot. What a nice segue. I'll just follow that segue and leave it to the next speaker, who is Rudy Aernoudt, and he's the senior economist at DG GROW at the European Commission. Over to you, Rudy.
Thank you, Nina, and thank you, Xavier, for this nice introduction. And I think, of course, GRC, they are really the knowledge center of the Commission. They have good data, and I just want to add some data to what Xavier is saying. If you look to the C rounds and the B+ rounds in Europe, because the good news is there, but we see that in 75% in Europe, US is in the lead. US funds are in the lead, mainly based out of London. So, and there we see why, as Xavier said, because it's bigger funds, but there's a second reason, which worries me much more, is that our European companies are cheap. If you look to the value, the European companies are based on 12 times EBITDA, while the Americans is 14 to 15. So it's a reduction of 20%. So you buy cheap companies, and what does the VC do? And of course, I like VC, there'd be no doubt about that. But what they do, they buy a fund, they buy a company, and they try to sell it 3-5 years later, because they are exit-driven. And exit-driven is exactly the opposite of sustainability. Because if you want, and that's the topic of the workshop, to be sustainable, to have impact, you have to think on the long run. And that's what I call the venture capital paradox. On the one hand, they are exit-driven, which is part of their business model. And on the second hand, in fact, you have to have long-term sustainability. So, in fact, the solution, what is that? Is that we have risk-return. That's what you always think about, risk-return relation. And now you have to ask the third one, like you're doing in your fund, Nina, impact. So, and that's for economists a big challenge. So, and I would ask the researchers around the table, how to put you in the model, not only risk-return, but the third factor, which is impact. And I would just be short by giving 2 examples what we should do. The first thing, I think, in research terms, we should try to show, and you have already some studies, that if you do impact, that you have a better, longer return. That you have impact, that your volatility is much less, so that you have less risk. So impact, we should not do it for the nice eyes of whoever, but because it in the market is the best investment today. So in my view, we should all go to impact. And the second thing is on policy. And Javier alluded to that. We calculated that today the public sector, and I see just Lerner there, I'm speaking about the boulevard of broken dreams now, just. Hello. What we see is that between 35 and 42% of the venture capital in Europe is public money. That's much too much, but that's another debate. But what we could do, of course, is saying, if we, through European Investment Fund, through the promotion banks like BPI France or Credentials for the Aufbau, or EFICO, all this, we could say, if we, by public money, invest in a fund, we can say that we only invest in funds that are doing impact investments. And that would change the whole world if we would that. So my conclusion is, it's perhaps a nice moment, a third good news adding to one of Xavier. It's a nice moment now to do something about it, to go for scale-up funds, and perhaps in the debate you'll have the chance to explain a concrete project which is called Escalar on that. And in that moment, you can push the VC to go to the market of impact. And so that will be my conclusion. Let's use our instruments to move to impact VCs.
Excellent. Thank you for that passionate plea for impact investing. I will always echo that. A lot of thoughts, also a lot of questions that we will come back to later when you talk about kind of the conundrum between being exit driven and sustainability, but we'll revisit that. I'm going to leave the floor because I think Luisa Alemani has not joined us today. So I'm going to move to Josh Lerner and Ramana Nanda. And I don't know who's going to start, but I'll leave it both to you. So Josh Lerner is the Jacob S. Schiff Professor of Investment Banking at Harvard Business School. And Ramana Nanda is a Professor of Entrepreneurial Finance and academic lead for the Institute for Deep Tech Entrepreneurship at Imperial College London. So welcome, gentlemen. I'll leave the floor to you.
Well, thanks. We're gonna
Thank you.
tag team. I'll just present the slides and then we'll tag team on the speaking. So hopefully you can see that.
Looks beautiful.
There you go, Josh, take it away.
Great. Well, thanks so much for the chance to present here. And sorry for the confusion and showing up a couple minutes late with technological issues. I think we can sort of start with something that probably we all can agree on, which is how impactful venture capital is as a source of financing. And I mean, we can see this in any number of statistics, but certainly one of the more dramatic ones is just how small the share of companies in the United States that get funded are, and how impactful those companies are. And moreover, it's not just simply a matter of the venture capitalist being in the right place at the right time. There's a pretty strong body of evidence today that there's a causal relationship, that the actual presence of the venture capitalists, and for that matter, angel investors, seems to be associated with more innovative outcomes and more successful firms. At the same time, as we'll talk about over the next few minutes, there is a sense that venture is not a one-size-fits-all tool. And in particular, while venture has been extremely impactful in a number of places and a number of technologies, there's still important questions about how general a solution it is in terms of financing. And we can dig into this a little bit more, but the question, certainly important questions around the extent to which this goes beyond, the IT space into the whole range of areas that we call tough tech, and if not, whether some combination of private and public funding can accomplish some of those goals. Another factor that we'll touch on, at least in passing, has been the huge influx of money into the venture sector in recent years. And certainly one of those aspects that's been associated with this is what we might term as founder-friendly terms and conditions. I think we all like friendliness, and founders are good people. So, and at least initially, it seems hard to object to founder friendliness. But on the other hand, it's probably fair to say that much of the secret sauce of venture funding has been associated with the kind of governance that's been applied in these settings. And one might well ask, in the influx of funding, whether there's been some, excessive relaxation of that kind of governance. And we can, obviously we have a number of very seasoned people on this panel, and it'll be interesting to hear, their opinions around these issues as well. If we could go to the next slide, maybe I'll take 2 more slides or maybe 3 more slides and then turn it over to Ramana. Let's just sort of start with the good news. This is some tabulations that we did in 2020, where for a review article, I think if we were to revisit this analysis today, it would be even more extreme, or certainly if we'd done it at the end of 2021, it would be even more extreme in terms of how beneficial or how impactful venture investments are. Again, we can sort of begin with the context that, if you look over the last 25 years at the United States, venture capitalists have funded between 0.3% and 0.5% of business starts, so really a tiny fraction of them. Yet, essentially, when we look at companies that have gone public in the last 25 years and ask what share of them are venture backed, if we look at market cap, we're talking about 76%. If we're looking at revenue, it's 50%. Perhaps even more dramatically, if you look at R&D expenditure, it's 89%. So essentially, virtually all R&D being done by young companies in the United States is done by companies that were originally venture backed. And again, this sort of indicates, how critically linked venture capital has been to the success of the American innovation model. And I think we could talk at considerable length in terms of how corporations have increasingly incorporated venture activity into their mix and the like. So there's a tremendous amount to celebrate and really like about what has happened in terms of the venture sector. At the same time, if we go to the next slide, we see that the way in which venture funding has been distributed is far from even. I like to, in a number of books or treatments of this stuff, go back and look at some of the portfolios of the pioneering venture firms in the 70s or 80s. And what one sees there is, such an incredible diversity of different industries, technologies being funded, and then contrasting it with what the portfolios of those same groups look like today. But one doesn't need to go back as far as the 1980s, right? This is just simply a comparison of global venture activity between 2010 and 2019. And in particular, you see that the 2 things on the bottom, which are the energy, materials, resources, IT hardware, right, have barely budged. While one's seen this sort of enormous surge in particularly IT, web-enabled services, and the like, that's really where the growth has been, an extraordinary concentration of funding there. Now, in some sense, you might say that's not a problem, right? That this is, this is sort of where, we know that information technology has had a huge impact. And certainly it's fair to say that this is a rational thing that the venture capitalists have done. And if we can go to the next slide, this essentially is a compilation by one of the consulting firms, Sandhill Econometrics, which essentially tries to break apart venture capital portfolios and create essentially what the return would be had you essentially invested pro rata in each given technology. So they basically are taking the portfolios of all the venture groups, essentially putting them in a blender and then reassembling them by technology. And the point that it raises is that when you look at the returns that are being gotten, essentially the IT, software, web space has just been extraordinarily high in terms of the returns relative to other technologies. Of course, the saddest one on the bottom there, Cleantech, where you would have ended up basically with a return that would have been, you know, essentially below that of treasury bonds. But really across the board, it's clear why we see that movement from hardware, from hardware and tough tech to software, simply because it seems to have just worked so much better in terms of generating returns for the investors. So in a way, while we have seen this, we certainly can't criticize the venture industry for focusing on places where they make money. After all, they have capitalism in their very name. If we feel that many of the technologies that are at the bottom here, are the are stuff that is stuff that potentially has high social returns, it really raises some concerns about what is getting funded, particularly if the venture stuff is increasingly critical in terms of where how innovation is being funded, both in the US and globally. All right, with that, I probably talked for far too long. So Ramana, why don't you take over?
Great. So I'll skip this slide. In our review piece, we talk a little bit also about the concentration of capital in certain regions, and the kinds of people who end up being partners of VC firms are quite unrepresentative in some sense of the population at large. But kind of coming back a little bit to the discussion about the returns of different industries, and tying it a little bit back to the two speakers before us, I think one of the things that we have been interested in trying to think about is what are some of the rationales for this relatively narrow focus of venture capital. I think one area that has been discussed a bit is the structure and organization of venture funds, the fact that they're often structured as closed-end funds for 10 years, and the fact that that might not always meet the requirements of investments that perhaps take a much longer time to pan out. I think that's leading to the rediscovery of some of these older models of greenfield investment funds that kind of remain evergreen funds that remain that are not closed-end funds. But we think that there may be something that's a bit more than just the structure of these venture funds that's at play. Josh spoke about the lower returns that seem to be apparent relative to the risk being taken by these venture firms, and there are sort of two broad areas that seem worthy of further investigation. The first is that many of these deep tech, tough tech ventures take a lot longer and require a lot more money, not necessarily to scale, but to de-risk these ventures. And I think distinguishing between the capital intensity in general versus the capital intensity required to de-risk the technology is an important one. We see the unicorns raising hundreds and hundreds of millions of dollars. So it's not capital intensity per se that's necessarily the issue, but it does appear as if the cost to put together demonstration plants or other prototypes in these deep tech, tough tech areas are considerably more expensive. I think the second has to do with just the way in which returns are generated. Oftentimes these deep tech, tough tech sectors are ones such as energy or materials, even a lot of healthcare, effectively involves selling into highly regulated industries with low margins, where your customers are also your competitors. And so obviously that's not a great way to make a lot of money relative to software, where you have high margin recurring revenue, subscription-based cash flow that obviously then leads to high multiples, which allows you to then exit in a shorter period of time. I think the role of government as a potential customer here is very interesting because they have the ability to backstop demand, to be an early customer, to potentially direct the use of technology. And that's an area of government policy that's perhaps not discussed quite as much as the role of government as a regulator or the role of government as a financier. But thinking about the role of government as a customer seems to be something that we think is interesting and promising. So we'll leave it there. Thanks.
Excellent. Thank you. Thank you for this presentation. I think I'm making some scribbles here on the side. Great threads to pick up on later. But what we'll do before that is to open the floor. We've heard from the policy perspectives and the academics, and we have the actual VCs left. And I'll start by inviting my fellow Stockholm local person here, Pär-Jörgen Pärson, who's a general partner at Northzone, one of the successful tech VC investors in Europe. Welcome.
Thank you so much. Northzone, we've been around for 25 years. We're on our 10th fund generation right now. We have about 3.5 billion under management, which makes us one of the larger players in the ecosystem in Europe, and also as of the past 7-8 years, we have a presence in New York. Anyway, I would like to start by saying that I think the 25 years that I've been involved with the venture ecosystem, it has had a tremendous positive development, and probably more so in Europe than anywhere else. And over the past 5 years, European venture capital returns have actually even eclipsed the US. And also I think the availability of capital has increased, and I do agree with you, Rudy, that it's still sort of too heavily reliant on the public money. But the fact is that with these strong returns, we're seeing more and more institutional investors actually making meaningful commitments to European based fund groups, and I think the also sort of adding to the discussion on whether we're sustainable or not, I would say first I would like to challenge the idea that we have a short time perspective. Most of the really strong outcomes in pretty much every VC portfolio, they sit for a long time. They sit for like 8, 10, even 12 years before you exit, because when you actually find a winner, then you want to ride it as long as you can in order to sort of maximize the outcome. And we experienced that with Spotify. We're experiencing that with most of our big outcomes. The other thing is that when it comes to sustainability as such, over the past 2 fund cycles, or Fund 8 and Fund 9, we actually ventured to see if we could describe our portfolio investments in the context of the 2 EU classes, Article 8 compliant or Article 9 compliant, which is, Article 8 is that you do no harm. Article 9 is that you are intentionally actually improving the world according to the UN Sustainable Development Goals. And it turned out that in our most recent portfolio, 75% of the investments that we made, the capital, was actually Article 9 compliant, and additional 10% were Article 8 compliant. So I would say that this entire transition, and I don't think that we're unique by any stretch of imagination, I think that this entire transition that's going on right now, that's driven by venture capital, is very much in its very essence a sustainable one. I'll leave it at there. Yeah.
Excellent. Many other new threads to pick up on. This is going to be a great debate, I think. But last and definitely not least, we're going to hear from Robert Kaplan, who is an impact investor, founder and CEO of Circulate Capital. Welcome, Robert. Rob.
Thank you, and good evening. Greetings from Singapore. We, Circulate Capital, are an investment management firm based here, focused on financing solutions to plastic pollution and climate change. We invest on behalf of some of the world's leading corporations and institutional and development finance institutions. I'm going to speak today from the perspective of a practitioner that's trying to deploy venture capital to create benefits for society, and specifically in solutions to plastic pollution. We are stepping back for a second, though. When we look at the cost of inaction and the returns of sustainable investments at Circulate, we're convinced that we'll see increasingly more commitments, especially in this region, to invest in models that generate financial, environmental, and social values. And that the COVID-19 crisis has really underscored further the need to invest in local resilient supply chains, industries that are contributing to strengthening resilience, protecting local communities, health, and livelihoods. And we're seeing a tremendous amount of interest in our work and those of our peers as we start to exit the COVID challenges. And so investing in climate change resilient solutions, such as the circular economy for plastics, is an opportunity that not just prevents societal benefit, but it's creating value for supply chains and building these inclusive supply chains that are beneficial for all. And we believe that we're at a crossroads. The time is now to invest in particularly these supply chains in South and Southeast Asia to collect, sort, process, and divert plastic from the environment and into industries that can use it for greater value. There's a huge technology opportunity to do that through advanced recycling or deep tech things like synthetic biology and new materials. But we recognize it's going to take many billions of dollars to solve the plastic pollution challenge and advance the plastic circular economy, and that this capital will ultimately have to come from institutional investors who are financing the future of infrastructure. But right now, they allocate most of their capital to things like bridges and roads and ports across this region. And what we're trying to do is show that there is a tremendous opportunity in these types of clean tech and circular ventures across the region. But right now, a lot of these investors, they don't see the pipeline, right? They can't find the deals. It's a very challenging way to find exciting deals. If you're looking at fintech or other e-commerce opportunities, you can go to a conference and find 100 new companies. If you're looking for these types of opportunities in Asia, it's not that easy. You have to do a lot of hard work to develop that pipeline. The second thing we've noticed is, there's just not really a long evidence-based track record. So people haven't made a ton of money doing this. I think we saw that in the chart earlier, and that's the one thing that scares investors away. So we need to see more returns developed to really crowd in that capital. And so that's why we built our strategy. We invest on behalf of companies like PepsiCo, Procter & Gamble, Dow, Danone, Chanel, Unilever, Coca-Cola, Mondelez, and several other development finance institutions and private investors to find these high growth opportunities across the entire plastic value chain, from those innovative materials to advanced recycling technologies. And we believe that an 80% reduction of plastic leakage into the ocean is possible over the next couple decades using existing technologies if we can implement them at a systemic level across South and Southeast Asia. But it does require a suite of solutions, from policy to corporate commitments to venture capital investments. And all players must play their part. So happy to share more about our journey and the work that we're doing in this space throughout the rest of the session. Thank you.
Excellent. Many thanks. We'll definitely be coming back to that. So thank you for all your opening statements. Really provided lots of food for thought, I think, and multiple things to pick apart in this conversation that ensues now. The way I'm thinking about this, that there are a few themes here. We are, after all, at the post-COVID summit, so we will be talking a little bit about the pandemic that we all want to forget about and leave behind us. We will talk a little bit about kind of the consequences of the pandemic, but I'd like to spend the majority of the session talking about, as we look ahead. But let's start with the crisis and the pandemic and what it's done to VC. I wanted to ask you, Rudy, if you want to summarize that from an EU or European Commission perspective, what has been the big consequence for VC in the pandemic, in the COVID crisis?
Yes, thank you, Nina. I think there, in my view, there are two main consequences. The first one is what Xavier is referring to: scale up money. We have lots, and the figures 250% is amazing. But the big difference before COVID and post-COVID is that before COVID, our big companies went overseas. We see that companies that find the money in the first and the second phase when they're looking for scale up, the typical Skype example, they went to the United States. 45% went to US to do their business. And now we see, in fact, that when I speak with entrepreneurs, said we don't want to move to the United States. So we see that now venture capital is coming here. US capital is coming from through London to here, and that explains the nice figure. So that's, for me, the first chance and the first change. And the second change, it's something I think for the moment we don't realize yet. We have all these nice figures about venture capital, about these things. And what we don't see is that we forget a bit the startup of the whole thing. What do you mean by that? If you look to figures, then we see that, and there have been some studies in the United States, I think sure that Jose is aware of about that, but even in Scotland from Colin Mason, for instance, we see that business angels, the main part of their portfolio, around 80%, is now invested in companies in which they have invested in the first round. So they are doing the follow-on. Why do we do that? Because the seed funds are closer to the market, so there's no alternative. And the second one is that these investees, these portfolio companies, due to COVID, needs liquidity. Now that's all good, but what is the other side of the medal? Is that as business angels invest most of their funds, and we already a lot of studies show that, into follow-on financing, we see now that the very first part for business angels is less important. We should not forget in Europe, 90% of all starters are financed through business angels, and 10% to VC and crowdfunding. So if we now have this risk and think we should intervene in time, if we see that in the beginning, the first round, the business angels don't have enough money anymore, then our pipeline will stop and there'll be nothing to invest for VCs and no place for IPOs neither. So my conclusion is, one, for scale up, let's look, do we mind if they use money or not, US money or not? And the second, for business angels, should we not try now to focus to look again at what we called before the small equity gap or the first equity gap, and should not focus on that again with policy, but perhaps Xavier from GRC is going to do some studies on that. This is an invitation, of course.
Excellent. I wanted to thank you for that.
Could I just jump in for a second on the angels as well, if I can, to build on Rudy's thoughtful comments? I mean, I do think that, certainly one of the things we're seeing from a policy perspective is more emphasis on promotion of angels and angel groups around the world. And, in many respects, I think, as Rudy pointed out, you can imagine that's quite productive, right? That you can imagine that in many cases, angels are investing with a more complicated objective function. And as such, they may be willing to do some investments that a venture firm wouldn't be able to do or willing to do, because they're really investing their own money rather than under some, burden of fiduciary responsibility. Certainly the work that Antoinette Shore and I at MIT did, where we looked at 13 angel groups around the world, it suggests that angels had a really positive impact on the firms that got funded, not just in the short run, but in putting them on a path to ultimately get venture capital. And what was interesting is that this was true not just in places like Israel and Silicon Valley, but also in markets like, which were less developed, like Argentina or Italy, where there's just less density of a venture sector. It seemed still that the angels were playing, they were funding later stage companies, not quite as young companies as the ones in Silicon Valley and Israel, but they were having a notable positive impact on the trajectory and the development of those businesses. Thanks.
Excellent. A plea for more active business angels, and we are happy about that. Like you say, I think everyone benefits in the ecosystem. I wanted to follow up on an idea, or like a thought both of you had, actually, Rudy and Josh, the whole perspective of public and private funding, and just trying to kind of tie a few of the comments we've heard together, also from your presentation, where you talk about kind of the totally outlier performance of software investments in the VC space, but that doesn't in its entirety fit perfectly with kind of reaching the Sustainable Development Goals, because I guess none of us believe that only software is needed to reach the SDGs. So I wanted to ask you about this thought on public and private funding. If you could speak a bit to kind of the learnings from an academic and/or policy perspective. Is the European model a successful one? Are there other models out there that are more successful? Do you have any kind of thoughts on that?
I can get us started on that, and then and Josh can perhaps jump in, and Rudy as well. So I think if one takes a step back, the question becomes, if you have a situation where you have investments that are not necessarily NPV positive, what is a rationale for government involvement? One is that we actually have benefits to society from this, as is the case with a lot of clean energy investments. The other is that there's potential spillover benefits and learning that we can get for other technologies, and therefore it's warranted to subsidize that. I think if we look at the history of public involvement, particularly for early stage proof of concept funding, that seems to often be quite positive. Where we see things somewhat kind of fall apart is where there's a lot of subsidies going for later stage investments, where it's not clear that that public money was necessarily deserved. And I think that kind of, in some sense, also provides a little bit of a template or a model for how one might think about catalytic capital or impact investment, which is that the point of leverage often is at the early stage, where there is some specific de-risking that requires to be done in order to get the engagement of the commercially minded investment. And if you can emphasize and focus on that side of, or that part of the capital supply chain, it actually has the ability to unlock that trillions of dollars that are out there in the global capital markets actually reaching for yield. I think one final thing I'll say is that there is a danger sometimes of over subsidizing early stage stuff. People talk about a scaling gap that exists sometimes, that all of these early stage companies have gotten funded and they're not getting scaling money. One interpretation of that is that there isn't scale up capital available. The other interpretation of it is that there is plenty of scale up capital available. It's just that those investments were not worthy of getting that scale up money and were given kind of this early stage subsidy that kept them afloat perhaps longer than they needed to. And so I think those are the two sides of at least in my view, how one thinks about the engagement at the early stage.
Yeah, the fast failure concept. Yeah, no, thank you for that. That's very helpful. I see that Xavier, you would like to comment as well. Are you with us?
Yes. Very briefly, my take is that the public sector should try to focus its resources on reducing the risk of certain investments in deep tech or long-term investments where the private sector might be slow to go. And this is the direction has been taken, for instance, in this recent EU initiative of creating the European Innovation Council. But there may be many others similar to that. And the second role of the public sector is giving some directionality to investments by public funds and also private funds where there are public goods collected, such as the green transition, that, as you know, become one of the top driving priorities for the EU, and where you really, in terms of taxonomies, in terms of regulation, in terms of markets, that will eventually make the investments by the public and the private sector successful. And directionality, to me, is the main role of the public sector. Leaving it to the private sector, wherever the private sector can be autonomous, economic returns on their investments.
Rudy, do you want to add something?
Yes, if I want to add to what Xavier said, and I don't fully agree with Ramana saying about the scale-up fund, because it depends how you define it. If from the point of view of Europe, we see that 75% of our scale-ups are financed through US funds, is that a scale-up gap in Europe, yes or no? Question mark. I think we could discuss about that. The second thing, as Xavier says, deep tech is an issue, but another issue is that we, in Europe, we don't have all that money and we don't have the big funds. To give you one example, in America, there are 48 funds with a capacity of 500 million. In Europe, you have 7. So that only is a figure that is saying we don't have the money. And I don't plead, as you have understood, to have more public money, because I said we have already so much. I plead that we try to mobilize private money. And again, one figure, the pension funds in Europe, 3 trillion in management. You know how much is going to the venture capital funds? I'm sure that my friend Jos will open his eyes now. 0.018%. You see, if we could mobilize 1% of the pension funds, we double the venture capital capacity in Europe.
I think that's a great comment. And can I ask?
Can I argue a little with Rudy on this one?
Go ahead. Who wants to go first?
I'll take a stab at it. So, we've done a series of policy studies in Australia over the last 20 years. And one of the experiments that Australia did is that, they have a very well-funded retirement system, thanks to the mandatory contributions people have to make. Is at a certain point, they essentially mandated or strong-armed the super funds into doing venture capital investments, really at a time when the venture sector was not really ready for those funds. They were essentially pressured into doing these investments. And essentially, there was a huge amount of influx of money into a small number of Australian venture groups who were not really at the time extremely professional, and where there was a limited amount of opportunities that were there. And unsurprisingly, a lot of that pension money got wasted as a result. And if you look at the sort of outcome of that experiment 20 years ago, there's been a sort of long hangover of it in terms of the pension funds being extreme. They're now investing in the US VCs, and to a limited extent the European VCs, Chinese VCs, yes, but they're not willing to invest in Australian VCs, in part because of this sort of long legacy of having been strong-armed into doing these kinds of investments. And I guess, certainly there's a lot of evidence suggesting the power of having local capital sources, but to do it, essentially with pressure to make those investments, I don't think, based on, experiences you see around the globe, it does raise some concerns as to, what the potentially unintended consequences of that would be.
But I think it touches upon an interesting question, though, how to reconcile the perspective. And I'd like to ask that to you, Rudy, from the European perspective, which is, we have these huge European initiatives, the EU Green Deal or the European Green Deal. I work in life sciences, and there's so many various programs, Horizon Europe and all of that. So there's so much soft funding going into this. I do think it's fair to say that Europe, as a region, is leading on kind of the sustainability transition from the pension fund side as a sector, or as a region, I would say, maybe not in absolute numbers. And so, how do you, I guess it's a question of different pockets, but the question still becomes, because I guess let me frame it like this and say, from an investor's perspective, of course, we see what you guys are describing, right? I mean, we invest in early stage companies. As they mature, they will at one stage or the other really consider going public in the US or look for significant capital sources from US investors. And if you really believe in, in the market economy in a globalized world, is that even a problem? But then you overlay that with what Rudy is talking about, the values and kind of driving towards sustainability and all that. And then I guess, you have a different angle to it or a different overlay. So my question to you, Rudy, is like, to your point, is there really a scale-up problem? Does it matter to the European Union if we don't, have enough capital for green transition, or should just the market economy solve that by itself?
Well, I think you must wonder, what is the role of public money? Huh? If the role is public money just to inject market on a monetary market, where is there a lot of money? I don't see the value added. The value added for public money is to act as a catalyst. I want to give you one example. Huh? Friends, we have InvestEU. InvestEU is the program for the next 7 years when we invest in venture capital funds. And we saw that in Europe, for instance, the venture capital, I think you should be sensible to that, you're only around the table. In Europe, we see that only 1.5% of the venture capital goes to women-led companies. Now, we did some research on that. What we saw, in fact, that in the investment committee, not the board, the investment committee is composed only by men. They don't invest in women-led companies. So what did we say? We say, if you want money for the future, you have one KPI to fulfill. There must be at least one female person in the investment committee, and the rest will follow. That is, for me, an example that from the public money, you can act as a catalyst. We could do the same with impact investments. We can say, okay, we have the Green Deal, we have all that money. And on top of that, you have the money that will be invested by venture capital funds. So we can say, venture capital, if you want that public money, that's what we want you to use it. It's not only about the scale-up gap, but it's as well because you want to accelerate something. And I think it was Rob or Pär who said the COVID makes things faster. It's like a transition accelerator. Well, let's jump on that phenomenon and say, from the point of view of public, we'll only put money in funds that do accept that to go impact. If you don't want to do it, no problem. But then there's enough private money in the market to do it. And the last element, and that's something I learned when I visited JOS, is this SBIC. So we copied your SBIC, JOS, but much better than yours, because we did something escalate. What did we do? We say, if funds, private funds, invest in funds, existing funds, we're going to double the capacity of the existing funds, but not by equity, but quasi-equity. What does quasi-equity means? That we limit the risk and we cap the return. And in that way, we want to attract pension funds, insurance companies to invest. And we act as a catalyst because we reduce the risk.
Anyone wants to go as a reply to Rudy? Okay, then I will switch gears and you can come back on that if you want. I want to switch gears and actually touch upon what you mentioned in the statement. And I'm sad to say that Luisa Alemani is not here. I was wanting to talk to her about the fact that I'm the only female on this panel, and I want to touch upon that topic. It's such a sad fact in the VC ecosystem that it's severely unbalanced from a gender perspective when it comes to capital, when it comes to the number of founders, as you mentioned, and when it comes to the investor pool. And you mentioned one of the outcomes of the kind of analysis you made, but I don't think it's the only one. So I'm going to ask this as an open question. Who wants to go first? I've heard Pär-Jörgen speak to this topic as well, so I'm sure you're going to want to come in as well. But I'd love to get your thoughts on that. Why are we not excellent? Great. So I think I'll let you, Pär-Jörgen, go first if you want, and then Josh, and then maybe Rudy and others. Love to hear your thoughts and kind of what are the main, from your various perspectives, what are the main underlying reasons for why it is so heavily skewed?
Well, I think that we have a history that sort of needs to not only self-correct, but it also needs to be actively managed. We started at Northzone this work already some 10 years ago when we were 7 middle-aged white dudes sitting around the table looking at each other, say that this ain't gonna cut it in the long run when we see a more diverse group of founders wanting to raise capital, and also to bring more diverse perspectives on what constitutes a great investment. So we have then changed and we were one of the first venture firms in the world to become gender balanced, and then we continued our transition also to involve more dimensions of diversity, because we do think that a true meritocracy has to be diverse, otherwise it's not a meritocracy. And it actually has also showed up, and we don't know if it's causal, but it certainly has shown in our returns that have increased quite a lot over the past 20 years collectively, and we have gotten the confidence of our LPs to increase our fund size and also our geographical reach by that. Currently, we follow up on how many of the companies that we're meeting every year, and that's about 5,000, that do have some sort of female co-founding or diversity element to it. And it's actually pretty sad that it's still not more than 25 to 30% of the deal flow that we see that has like some sort of a gender balance to the mix, and we over-index on the actual completed investments more than our deal flow actually reflects, which goes to show that I think that in order to be a truly exciting startup, you have to have a diverse setup as a team. And I think also sort of tying back to some of the earlier comments here, I do think it's you can only to a certain degree sort of push this from above. From it has to come from below, that the real power of venture capital rests on the assumption of really strong entrepreneurs who want to change the status quo. And that's when we see strong mixed teams or women-led teams that they come to the market. They have access to more talent, and they are more competitive in the talent market. I would also like to briefly mention an initiative that I'm part of. I'm part of the First Close Partners, which is a group of investors, Josh Kopelman of the US, Teresa Gao, myself, Ed Zimmerman, and a few others. We have put together a fund of funds that invest in underrepresented managers, and those managers have access to also to a different kind of deal flow. And the interesting thing about this structure, the First Close Partners investment returns to date has actually been at par with tier one venture returns. So there's nothing that suggests that this is something that is less capitalistic or less successful by any stretch. So I truly believe that this has to come from a bottom up, and I think the public pressure should be there, but we should also be careful of funding stuff that, as Josh says, goes to waste when it's put in the hands of people with no experience.
Josh, you want to come in?
Well, I think, we've done a variety of work with the Knight Foundation in the US on diversity and asset management more generally. And I think it's worth underscoring that this is a venture capital issue, but it's also a more general issue in asset management, at least in the US where we focus, that that it is, particularly when you look at the ownership of firms as opposed to the mixture of the staff working at the firms, that it is a pretty that the representation of both female-owned firms and minority-owned firms is quite modest, strikingly modest. And in some sense, when you look at venture capital, for instance, in the last couple of years since the prior study we've done, we see, for instance, a lot of entry by minority-owned funds, but many of them are raising $20 million and $40 million funds, and you compare that to one $8 billion Sequoia fund, and as one can imagine, it doesn't really move the needle. But I think the one thing that is clear is that this is an area which is a venture issue, but it's also a much more general issue in terms of asset management. And as such, there's probably a whole suite of things that probably need to be done to address it.
No, I think that's fair. That's absolutely true. I guess one assumption in relation to VC is that these are young companies. And so you would think that it's kind of easier to do things right from the beginning than to correct old mistakes. And I'll be provocative to say that, you know, when you look at both on the investor side and some of these startup sides, you get a bit depressed because they're really repeating the mistakes of previous generations in terms of lack of diversity. And I guess maybe that's one reason why people are more surprised, maybe, when we look at the modern economy and the same patterns. But fair enough, it's an industry-wide issue. Rudy, do you want to come in?
Yes, if I may, thank you. First of all, to answer to Pär-Jörgen, go to waste. There have been some studies, like for instance, the Boston Consultancy Group, that shows that the return on investment for women-led companies is 2 times higher than man-led companies. So I think we should rather inform or perhaps have more research on that, and showing that it can be some. So you're right, it should be bottom up, but we can show that it's not waste of money, you know, that you can return. Now on the reasons, I think, and I published a paper last year on the women financing, and what we saw in the sample, that from all the hot pitches, so I mean somebody pitching for money but has been recommended by somebody else, 80% were hot pitches, and they were all recommended through the old boys network. So that comes back to what you're saying. It's a cultural aspect. It's man saying, you look at my friend who has a business, and that comes to the VCs. So the one is the pipeline, and the second one, so that's the supply. The second one is the demand, and we have made some studies showing that women, and I don't know why, perhaps Nina, you can explain, they're anticipating a refusal, and so you have less women asking for money or asking for less money, and that's an anticipation behavior which you could significantly show statistically. So I think that's real quite a lot of things that we can work on.
Ramana, I think you had your hand up before.
Yeah, I just wanted to jump in on a very similar line, which is that the network nature of deal flow in the venture business is, you know, it's important in some ways, right? There's a lot of asymmetric information. You learn about good deals through your network. So it's not to say that we shouldn't be using our networks, but our networks, we know, are inherently ones that are not kind of equally spaced out. There's homophily in many ways, and that can drive in many ways this matching between the sort of the gender of the partners and the entrepreneurs. And so I think these the sort of the goal to diversify the partnership is a very important one, because it can have a lot of leverage in terms of driving that through the kinds of people that are picked.
No, but I think that's true. But I would also agree with Pär-Jörgen that I think if you look at deal flow, and I haven't done it in a few years in a systematic manner, but I'm very sure that the amount of deal flow we see by female-led founders, or whatever definition of diversity you want to use, is of course in a minority. And I think as an investor, like you say, it's a tricky discussion to have with yourself on biases, unconditional biases, unconscious biases, and everything else that plays in. But I think it's not only about the network, because I represent that other network, right? But even in my network, there are not as many female-led companies, so it's more
right.
tricky.
And I think one of the things that, so I've done some research with colleague Sabrina Howell, where we were looking at very early in the life of of ideas, so looking at venture competitions, venture plan competitions, and you see that the share of women entering these venture competitions is about proportional to the share of women in the business school, but then as a proportion of those who are in that competition, those who go out and found new businesses, it's actually a lower share. So you see this decline happening very, very, very early in the sort of the life cycle, in some sense, of people deciding to start companies, which goes back to the point that the sort of the proportion of women seeking funding is actually not obviously equal.
Xabier, do you want to come in?
Yes, I can think of three things that can be done to promote more gender balance in the venture capital industry. First of all, the issue of quotas. I think that the public sector probably has a duty here to start introducing quotas. Some have already been introduced, having at least one member of the investment committee of venture capital funds being female, for venture capital funds to be supported by the public sector. Progressively, that could become 20%, 30%, 40%, and I think that one would move in the right direction with time. Second, I have the impression that culturally female entrepreneurs tend to be more driven by social values and environmental values than men, and possibly I would think that the drive towards the ESG goals and the green transition might attract with time more female entrepreneurs to become venture capitalists and to be active in this sector. And finally, coaching. I think that what we have seen is that many young entrepreneurs, non-experienced entrepreneurs, can benefit a lot from coaching from more experienced venture capitalists and entrepreneurs, and the public sector can also play a very important role in nurturing a pipeline of venture capitalists, female venture capitalists that will become the leaders of the venture capital sector in the future. So there is a role there for the public sector, which I think has to be fulfilled.
I think those are good points. And actually on the last one, I've actually feeded that back on the role of the EAC and the EAT systems to really, beyond capital, really look for that coaching role, not only for females, I mean, for in the role of like having an ascribed chairman or the chairman type of role to these young companies, but I think it could serve the same purpose in terms of supporting on the investor side. Great. If there are no many other thoughts here, I want to switch gears again.
Can I make, I mean, maybe
Please.
this is politically incorrect to say, but I'll just still throw it out there. I mean, there have been a number of studies done of the sort of mandated representation by gender, a lot of them focusing on Norway, which was one of the premier places. And, I think, the evidence is pretty mixed as to whether it has positive effects on firms or not. I mean, there's several studies, and as usual with academics, they sort of, they come out in somewhat different places. But, I think the general conclusion is if you want to see this as some sort of cure-all in terms of things, it's probably not going to necessarily, mandated quotas is not necessarily going to be a huge winner in that sense. But that's probably a whole nother debate for another day.
Yes, and a very lively one, I think, because now the European Union is introducing various types of quotas in terms of, board representation and so on. Being the only female on the panel, I'll raise my hand and say I still think quotas are really interesting, because when we look backwards and see the progress that's happened, I'm not impressed. So if there are new tools to get us further and more accelerated, I'll be open to that.
It's actually, yeah, if you think of it, it's actually quoted, there are quotas anyway with the old boys network. So, it's just a different kind of quota.
That's it. Thank you. Thank you for saying that. Oops, I don't need to lower my hand. Okay, so I'm going to switch gears again, and I want to go to you, Rob, and I want to hear what you have to say on kind of trying to champion the impact investing space and the green transition. What would you say? What's holding back additional VCs? I mean, so we are both in the impact investing space, and we know that it's still, beyond kind of perhaps the LP talk and the phrasings. It's still a niche space in the VC world. What do you think is holding back additional investors from investing in models that generate financial, environmental, and social value?
I do think there's a lot more talk in this space than action. I'd say probably one of the biggest challenges has been where LPs are placing their bets, right? I think there's a lot of funds who have been trying to raise capital, and it's very difficult to do it. You run in, when you're talking about large amounts of capital, you need to be on your 7th, 8th, 10th fund, as Pär-Jörgen is, and it's hard to raise large amounts of capital if you're not there yet. So LPs aren't willing to take emerging manager risk, and most established managers aren't willing to expand their strategy. So I think that's been a big challenge. I think There, you have a lot of generalists strategies out there that have been trying to incorporate impact into what they already do, rather than really thinking about an impact strategy to solve a problem, right? So it's kind of chasing ESG or impact as a checking the box exercise, as opposed to saying, you know, we have a serious opportunity here, and impact investing is part of the solution set to that opportunity. And so there's a, you know, tail wagging the dog problem that I think has been holding back a lot of firms from really being able to raise the capital and deploy the capital in effective ways, which kind of also then creates a self-fulfilling prophecy because they're not generating the returns and the track record to unlock more.
Right. Interesting. I want to touch upon that, but just a question first, because I think it was Josh in your presentation earlier, you spoke to, at least I perceived it, I won't paraphrase, but I understood your comment to be something in the likes of, it's attractive to be in the software space, and it's not attractive as an VC investor to be in the non-software space. And I wanted to ask you, Rob, and like, is the perspective that impact investing is more difficult? Is it, I mean, like, if we think about green tech going forward, with all the kind of demand there will be for various reasons, you know, consumer pressure, regulation, the need for green transition, there must be winners, you know, like I think we're all somehow convinced that there must be market winners in offering solutions. So,
Yes.
So it's probably not, we have to hope that there will be correlating commercial returns, but is it more difficult to do impact investing? Is it easier to be in the software space, or like, why aren't we seeing it beyond the reasons you just outlined?
Impact investing is held to a double standard. Not only do you have to generate financial returns, you also have to exceed on impact returns, which means you have to do twice as much work as a standard investor. If you fail on either one of those, you failed, right? So it's much harder to achieve those types of results. But I also think that, you know, that chart, which I reacted to as well, you know, brings out, there's other issues behind that, which is, does the venture capital model really work for clean tech? It works great for software, but when you're talking about hard technologies like, you know, advanced recycling technologies or renewables or hardware, it doesn't work for the hard technologies in general. So there's some of the structural elements of venture capital on, you know, the closed-end funds that we heard about earlier, the exits that have to happen in 5 to 7 years, I think are part of the correlation there, rather than just saying, oh, it's clean tech that can't drive those returns. But we also, over that period, had a huge bust cycle for clean tech. So there was during the 2009 recession, there was a significant amount of capital that went into clean tech in the late 2008 to 2010, and everybody lost their shirts on. And so, to the sort of Australia hangover comment, there's been a huge hangover in clean tech for the last 10 years and a significant underinvestment in it, which has only just recently shifted in the last year or two, which actually I think is because of COVID and sort of everyone recognizing that there's a huge opportunity in impact and wanting to think more impactful about their work. So we've seen a significant uptick in that, but it's been a 10-year drought in terms of significant investments in the space.
Ramana, I'm going to let you in, but I just want to follow up on this question very quickly to say, I thought about this whole Australian hangover comment as well. And I wanted to ask basically all of you or whoever wants to jump in to say, as we look at green tech, climate tech, whatever we want to call it, there is such an inflow of new managers. To your point, Robert, I mean, if there's one space where we do see emerging managers that come from the founder side, they come from kind of non-traditional VC sides anyway, because there was the kind of clean tech wipeout. So there aren't that many green tech investors out there. Is that a net positive to the sector, coming in with fresh eyes, kind of different experiences to the VC world and thinking differently? This is a prediction comment, or is it a risk again for like unexperienced managers to not deliver superior returns? What's the net effect you would foresee in the coming years? Is it a successful clean tech era or a clean tech 2.0?
I mean, I am worried about it. I think there's a lot of money flowing in, chasing a lot of deals that probably don't exist. You see it in the valuation inflation. right? So deals that probably aren't worthy of those valuations, the price is spiking because there's more capital available than there is supply. So I think that, is a bad indicator. But I still think there are really quality deals, and I think the environment has shifted a lot to make the enabling environment to make these companies more successful right now, with the policy enablers and sort of the momentum in a variety of different places. So I think it's going to be there, but there's a lot of risk.
Pär-Jörgen, you want to come in?
Yeah, so we were one of the funds that lost everything in the Cleantech bubble. Well, bubble is not the right word, but we made some 15 or so investments in those days, and I don't think that any of them managed to return their cost of capital. They were extremely dependent on government subsidies, pretty much all those investments, and that was part of the problem when the financial crisis of 2008 struck. Then all these subsidies were pulled, and basically it was a bigger value destruction than the dot-com collapse. From that perspective, and so what's different now? Well, I think there are a couple of different things. I think the really capital intensive ones are now being done with customer financing already at the design phase, which is pretty interesting, and that didn't exist at the time. And the other thing is that there are quite a few of them that are not so capital intense. And that I think points to a more probably a rosier future for this, the opportunity for impact investments and for the kind of clean energy and stuff like that. So I'm much more optimistic now than I was maybe 5 years ago, because then we would not touch this space. But then again, like I'm on the board of a company called Hopin, which is basically a conference, a virtual conference platform, and you could sort of, what does that have to do anything with sustainability? Well, it was actually conceived, the idea was that most corporates would want their employees to travel less to conferences, so to reduce the carbon footprint was sort of the underlying idea. Then obviously when COVID struck, they hit a jackpot and got the biggest growth that they could you could even imagine. And now post-COVID, the behavior is there. So they were obviously funded under the pretext of being a sustainable company, but that was not what made them great.
You need a crisis every now and then.
Yeah.
Okay, Ramana, I'm going to let you in. Sorry.
No problem at all. I'm just wanted to respond to your earlier comment about sort of impact and the potential trade-off between impact and returns. I think you will always find some great companies that generate incredible impact in environmental terms and generate a lot of money. But the very fact that you need to have an investment class called impact investing, I think says something, because if everyone was making a lot of impact and making a lot of money, you just have investors, you wouldn't have impact investors. So the very fact that you have impact investors appears to suggest that there is some kind of a trade-off. And of course you will be able to cite the 2 or 3 or 4 examples where you can have a lot of impact and make a lot of money, but the general point still remains that there are a lot of sectors where there is incredible benefit to society that might come from certain technologies getting commercialized, where you are creating incredible amounts of value, but you may not be able to capture that value as an individual firm, which then makes it such that profit-seeking investors like VCs will have a hard time putting money in. So I guess that sort of is my position on that. As it comes to the sort of the second clean tech wave, as it were, I think in addition to all the other factors that have been said, the one thing that probably is worth mentioning is that consumers are much more ready to embrace making trade-offs in terms of their purchasing decisions, in terms of the prices that they pay, in terms of a whole bunch of other things, which then has follow-on effects in terms of the way in which the follow-on effects in terms of the way in which you can have some. Josh is smiling, so I think he's going to have a retort. I guess I've lived in Europe now for 3 years and forgotten about American consumers, but certainly there is a large number of European consumers who are willing to put their money where their mouth is, and perhaps that has an implication for the kinds of businesses that can be built in those ways.
I'm going to let you come in, and actually there's Javier before that, but just perhaps a small, a pretentious quote by the fantastic Nelson Mandela, I think he said, "They say it's impossible until it's done," and I just throw the question out there of saying, how much, and that's what I think the question I was asking Rob before. My impression is very much that. How much is it about business as usual and thinking in the cliche of the box, as opposed to just thinking about how you can apply, the very powerful tools of VC in different ways? I think that's my question to the VC community at large, because the examples you give of kind of you can create a lot of value, but it's not easy to capture. Of course, there are those examples, but in my field, which is life science, I think about how can you actually think about widened access to innovative medicines? And at the bottom of that question is really, there's an overlap. There are people who are willing to pay, but the players today are busy catering to other customers. So there must be an opportunity to capture that value for people who are willing to pay. And I think the same analogy, as I think about green, I can see many examples of that. So the question really is about, how much is it business as usual and how much is it like the likes of us thinking in different ways? But
I mean, maybe I'll just give a silly example, but, a vaccine for malaria versus a cure for erectile dysfunction. I'm not going to make a value judgment of what creates more value in the world, but there's certainly one where you have a market for reimbursement, where you can capture a lot of value as an investor. And there's one where you just can't capture much value. And I think that there is tons of evidence in healthcare which suggests that innovation is going in directions where you can get reimbursed for the innovations that you put together. And so, and I believe the same is true for energy, up until the point that we can pay for clean electrons differentially from dirty electrons. It is much, much more difficult to compete as an investor, and therefore you don't have the returns. But
I look forward to continuing this conversation over the coming years. I think malaria is a particularly tricky example, also with the likes of Gates Foundation and others who are, exploring the non-for-profit side of things. But yeah, we'll continue this conversation in the years to come. I look forward to that. I'm going to let you in, Javier. Thank you for being patient.
No problem. I think that another factor that is going to play a major role in the development of clean tech and creating market opportunities is the crisis that we're now living in Ukraine, following the invasion of Russia and the sanctions that are following suit. As you know, this is leading to an increase in prices of oil, gas, and an acceleration of the need to find alternative energy sources, at least in Europe, very quickly. My impression is that it is going to have a major impact on the deployment of new technological solutions in the European market and probably in the rest of the world very quickly. And there will be huge market opportunities for investors in this sector over the next few months and years.
Perhaps the only single silver lining of this terrible situation. Yeah. Josh, did you want to come in?
I guess I would just sort of emphasize, really, just underscore Pär-Jörgen's point about the importance of, new models of pursuing many of these technologies, that in a lot of ways, it seems that the application of, if you look at, certainly many of the companies that were funded during the clean tech boom of the 2000s, right? You saw, very capital intensive models in many cases where things would, work in early stages, and then when they scale them up, they wouldn't work to nearly the same specifications and so forth. And it just is very hard to fit that with the venture model, right? Because essentially the whole venture game is avoiding too costly dry holes. What one wants to do is fail quickly and cheaply, and then move on to the next thing. And I guess I'm much more optimistic about that than expecting some sort of, at least from the U.S. or Chinese consumers, some sort of major change there, right? I mean, in the U.S., the price of oil goes up by, the price of gasoline goes up by $1, and we're rolling back gas taxes, doing Biden administration's opening up federal lands to oil and gas explorations and so forth. I think it's much more about figuring out ways to enable clean technologies in a way that's cost effective and which fits somehow with the venture model.
And do you think then, it's an open question to all of you, do you think then that this is an opportunity for Europe? I mean, because I guess we've said it, many of us in different ways, that the European consumers and the European pension funds and the European landscape period is perhaps the region thinking most about sustainability, if we generalize. But nevertheless, in absolute terms, the US is of course always very strong on innovation. So another prediction question is, if you were to look kind of 10 years ahead, where do you see the next epicenter of green or SDG related innovation to be coming from? Javier, go ahead.
Well, I would want to think that hydrogen technologies and their deployment are going to be one of the big game changers in Europe and in the rest of the world. I do agree that the deployment of this technology is very challenging, and the involvement of many actors in the value chain will have to be put together. But in my view, that's going to be a winner for many investors as an alternative to batteries, oil and gas. That's my 2 cents.
Excellent. European hydrogen. Sounds good. Did you want to say something more? No. So I wanna move on to another comment that was struck upon in one of your opening statements about funder friendliness and kind of the tech sector. And I want to ask you, Pär-Jörgen, but also you, Rob, perhaps, and open it to everyone after that, really to hear kind of the thoughts on the role of the venture investor in relation to the startup. And I think it was you, Josh, or you, Ramana, who spoke to this founder friendliness and kind of how over time, when there's a lot of capital in the market, some of the typical VC terms are kind of diluted, and it's very much kind of a lot of power has gone to entrepreneurs, and some would argue rightfully so, and maybe others would argue that that's kind of diluting the role of the investor. I'd love to spend a little time on that, Pär-Jörgen, because I can imagine that you are very much at the center of this conversation, and having been there to live the evolution over the ups and downs of investing in the VC space. What are your thoughts?
And so the easy answer is that, like, in the early stages, the valuation almost doesn't matter. It's the farther you go down the development path, the more important it becomes. And then it's more in the early stages, it's more about the other terms, to what extent the founder actually is in control or has to sort of comply with ideas that investors have, most of the time I think the investors are I think the best thing an investor can do is to be on demand and stay out of the way, and to make sure that you make the right selection in the first place. And if you do that, then you will be well referenced for other entrepreneurs as well, because the really strong entrepreneurs don't want you to sort of have your hand on the wheel. And I think that's how we've seen pretty much all our successes unfold over the decades that we've been active. And there is this really interesting faulty concept of like an active investor being someone who's basically rolling up their sleeves and doing some good work in the companies, and great entrepreneurs hate that. They really don't want you to be involved. But of course the LPs thinks that sounds kind of good when you do that as a VC. It's really important that you get the right kind of relationship with the right kind of entrepreneurs in order to get outsized return. So we're spending a lot of time trying to understand what the entrepreneurs really want from us, and what they want from us is help with recruiting. And then to be a strong advocate when they really need it, on demand, and that's what really constitutes, I think, a strong relationship with an entrepreneur.
And can I ask you then, because I guess the software space has taken off over the past decade or so, or more. And do you see then, like, does this correlate to an evolution on the founder side, serial entrepreneurs, more experienced entrepreneurs? Because I think in some ways what you're describing is the model you think about when you think about experienced entrepreneurs that have been around, know what they want to do, know how to do it, and you are there as an experienced partner. But of course, when you look at the European landscape, overall, I would argue in VC, that's not always the case. It's what first-time entrepreneurs, maybe like in the deep tech segments, ex-scientists that become entrepreneurs, and they might have a strong will, but don't necessarily have the experience or the bandwidth or the network to achieve that vision. Is it a reflection of maturity?
Well, I would say that the really strong entrepreneurs, they reach out and talk to other entrepreneurs, and we are happy to make those introduction and have them, talk to others to help them navigate how they want to build their companies. And I think that there is obviously at some point in time, and perhaps a little bit of a over-indexing on this last year, before everything started to correct, was that some entrepreneurs were only optimizing for valuation and not thinking about what kind of long-term partner they had. You're going to camp together for 8, 10, maybe 12 years, and you better have a partner that actually is productive for you during that time period.
Rob, any thoughts from your side?
I agree with most everything there. I'd say, when we approach these conversations with ventures, it's very much about how do we build trust, and that often comes across in the terms, because a lot of the terms, especially with first-time entrepreneurs, they don't understand them, and so it takes a lot of time to build that trust and explain the implications and where those trade-offs are. We've seen the valuation optimization challenge significantly. We all see a part of that is driven by other investors as well, who are coming in and have a lot of capital to burn. So they're more interested in getting a deal done than thinking through what's in the best long-term interest of establishing that trust. The only other thing I'd say is, we focus a lot of our time on strategic value. So, we invest on behalf of a lot of large corporates like Unilever and Coca-Cola and Pepsi, who are the ultimate customers of our ventures. And so being able to bring that strategic value without the negative perceptions of a strategic being your direct investor is a key way that we've been able to overcome some of those term issues.
And do you see, to both of you, do you see in this phase of the market, as you talk about, like we've had a very upward moving trajectory last year, and now it's starting to correct. Do you see trends or shifts in the expectation of founders and entrepreneurs, what they look for you to do? You spoke of recruiting, Pär-Jörgen, but do you see, especially maybe also when we talk about non-software companies and for example, green and so on. Do you see kind of the same recurring needs, and what are they?
Well, yeah, I think there's when it comes to recruiting, we have three full-time employed headhunters who do nothing else than try to help identify potential people who would fit into the bill. Because if a startup may need to recruit 400 or 500 people in a year. That's a lot of people that needs to you have to go through and vet and all that stuff. So that is by far the most important one. Then on the customer side, sometimes we do have also good relationships into sort of the key customer bases. But more importantly, I think, is that we represent that to the prospective customers, that this is a company that has been, that's in it for the long run, that has the kind of financing backing and is associated with the successful financing partner that makes them much more serious, especially in the very early stages, than someone who's sort of standing on their own. So I think we do have an important role to create, help the entrepreneurs to scale. But again, it has to be on their demand. We can't sort of cram them down on them. That will never work.
Any additional comments from you, Robert?
No.
No.
I might just add, actually, so, I think as Pär-Jörgen was saying, the sort of developing a reputation as someone who can, it is important for venture capitalists because it helps VCs win deals in competitive situations. And early in the life of companies, the valuations are kind of secondary in some sense to just getting into the best deals. I think some of the challenges that appear to arise are when VCs give up important terms that come to bite them in the backside later down the road. Those, I think, particularly have to do with their ability to replace the CEO if that is needed. And many CEOs are great for early part of the journey and then have a harder time transitioning to scaling well. And those are moments in time where, from the perspective of an investor, they would prefer to have founder redeployment, as it were. But for a variety of reasons, one, because it's not necessarily the best reputation for them to get the next round of deal flow, and two, because they may have given up terms, they may choose to not do so. And it is absolutely the case that the very best rocket ships never need VC's help, right? They take off despite the involvement of any venture investor. But then there are a whole lot of other ones that need to be slogged across the line, and presumably that's where some of these control rights and cash flow rights actually do matter, and it's really there that end up kind of making the difference.
Yeah, but they seldom really move the needle on the returns.
That's right. They don't move the needle on the return, but presumably they will help you get deal flow because someone will give you a good reference for having worked hard with them to take the deal from 0.9 to a 1.3 or whatever, help them feel like they got placed as an acqui-hire in a good place and made it such that their CV looked really nice.
I also think it really is a question of, to Rob's point before, what part of the VC space we're discussing. If you're a very kind of thematically driven investor, then I do think that the founder pool is slightly different from some of the segments we've been discussing here today around software and others. I would really argue that is different. I'm myself as a medical scientist by background, and the companies we invest in, it's often scientists, and I think they don't typically are not the white t-shirt, or excuse me, gray t-shirt Valley bro. It's a different profile, and the partnership will be different for that reason. We're approaching the end, and I would like to take a chance to ask all of you to make a final round around kind of your predictions, or rather the following question: what do you see as the main, the largest opportunity for the VC sector? So it's a broad question. You can address it the way you want, and being last is always the best because you have time to think. But what is the largest opportunity for the VC sector over the coming 5 to 10 years? And a brownie point for the person who goes first. Thank you, Josh.
I think that the hugest opportunity really is in terms of the rethinking that's underway in terms of how innovation is pursued in society more generally. That, while historically we had these beautiful ivory towers in terms of corporate research labs, I think with the benefit of hindsight, looking at them, many of them just weren't terribly efficient in terms of identifying new products and translating it into the marketplace. Similarly, I think if you look at the track record of government R&D, at least outside of, giving money to universities, which of course is perfect, there is a lot of issues in terms of the translation of the government funding into really commercial innovation. And I think there is really a tremendous, it's changing already, but there's much more to go in terms of venture, which seems to be very good at that translational process, playing an important role there.
Excellent. Who's next?
Let me chime
next, if you agree.
in. Sorry.
No, go ahead, Ramana.
Okay, well, I'll just chime in just because it's sort of jumping on the bandwagon of Josh a little bit. And it's also related to what I've been working on a little bit at Imperial, which is that, there are these grand challenges out in the world that we have around climate change and human health and sustainability, so-called deep tech. And a lot of these depend on the translation of fundamental science into technology. And we actually know that venture capital has the potential to be involved in incredibly transformational technologies that also build on fundamental science, but there are important challenges that exist in taking the stuff that exists in universities and bringing it out into the world. And I think some of the big opportunities here lie in the ability to find a good model to take some of that great stuff that's happening in universities and bring it out into the world in a way that can not just create value, but capture value. And to, as Josh was saying, move from a university environment where there's a lot of sort of research for research's sake, and focus it a little bit towards the goal and the output of developing innovations that have solving a very clear need.
So VC deep tech and translation. Xavier, go ahead.
I think that I'm going to go deeper on the issue of deep tech. In my view, there are going to be huge opportunities, at least in Europe, to invest in deep tech companies around the pipeline of companies that are going to be selected, promoted, invested by the European Innovation Council, and to some extent the KICs of the European Institute of Technology. I think that there is a pipeline which is very powerful. We are beginning to see the fruits of the work that has been done over the last couple of years. In my view, there will be huge opportunities for venture capital investment to make a lot of money, whilst at the same time address societal objectives, clean tech objectives in Europe and in the rest of the world around these companies that are going to be selected following a very thorough selection process, which seems to be working and leading to the right companies being selected and successful. That's my 2 cents again.
Bright future for European startups and VC. Sounds good. Who's next?
I'll get in there. So, I think obviously we are making big bets on circular economy and new materials. But I think, at a macro level, the big opportunity I see that's probably underinvested is emerging markets. Venture capital is such a US and even to a lesser extent European focused opportunity. As someone out here in Asia, I think the potential here is really tremendous and probably where a lot of venture returns will start coming from over the next decade.
I totally agree. Totally agree. Go ahead.
I would say that the digital transformation that's been going on for a while has still sort of 5 to 10 years of significant value creation ahead of it. It's at the order of magnitude, I think, even greater than the buyout sort of mega trend that started in the 90s, and that's kind of still ongoing. That's one thing. The other, I think the entire healthcare sector, just in the US alone, you have $4 trillion, which is probably the worst spent money on the planet right now, and there is so much innovation going on there. So where you can actually, as a venture capital investor, make some pretty significant big bets and with enormous outcome potential. The third one I would like to highlight is that I think is more long term, but it holds a lot of promise. I think it's when we see the basic building blocks of the blockchain come together, and that we see there is almost like a new level of abstraction when it comes to how societies are organized and how companies are being formed, with everything from distributed autonomous organizations to different kinds of incentive systems. It's not without problems, both in terms of regulatory environment and it's currently a pretty inefficient structure, but that's being discussed on how to be fixed, and that's why I think it's a long-term opportunity.
Excellent. So I think for the people in the crowd, I hope you've listened carefully, because you've gotten some good advice on kind of what the sectors to look at. To summarize, I think we will all agree that the challenge that we face ahead, as the challenges we face, are no less than daunting, and they will require some of the transformational technologies we've spoken to, active capital markets, and last but not least, which we didn't touch upon as much this time, really the bold leadership from all sides. But humankind never ceases to amaze. So I think we all are very positive still on what we see and kind of the investments we will see over the coming decade. So it will be exciting, that we can be sure about. So with that, I would like to say thank you to all the speakers, and last but not least, also thank everyone who's been attending the session, and we wish you a good rest of the conference. Thank you very much.